Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide mediation and valuation services based in St. Louis, Missouri. Today, we will discuss M&A sports franchise valuations with Edwin Draughan. Edwin is a sports franchise valuation expert based in Los Angeles, California, and has been a member of Park Lane since 2017. Park Lane is a boutique sports-focused investment bank founded in 2005. Edwin's primary responsibility at Park Lane is to lead the firm's efforts with sports franchise valuations and due diligence, which also includes the client relations, market awareness, deal sourcing, and execution. He also plays an integral role in the firm's sports franchise M&A advisory, early stage capital raising, and traditional real estate divisions. Part of the regulations, if you will, with a sports team has to do with the league, has to do with the location, has to do with the city, giving some sort of priority, if you will, or some advantage, tax advantage to building in a particular area. But another thing that I'm wondering that if we compare it to regular businesses, so a lot of times we're going to tell a regular business, hey, if you've had 2-3 great years, right, this is going to be the best time to do this. Whereas I can imagine that if a sports team is like on top, right, they've just won a championship or something like that, the owners are not going to necessarily want to sell at that point because it's sort of like a hobby investment. It's an enjoyment investment. So if we're on top, why would we sell even if we could get the highest amount? Because it's really for the enjoyment of being in that box, right? And having those people come to that game. So do you see teams ever kind of selling when they're on top, or is it mostly when there's some struggle?
I think by and large, teams don't sell based on what's happening on the court or the field.
Okay.
They primarily sell based on their personal preference or maybe what's happening in their personal life. A lot of these assets are generational, means they're passed down from father to son, etc. Oftentimes, kids don't want the asset. So in which case, the owner is getting older, they're looking to retire, they're looking to calm down. In that case, they would sell.
Mm-hmm.
So primarily, that's what we see as the main kind of driver for owners to sell. And you actually brought up something, and I kind of wish I thought about this back when we were talking about the differences between businesses and sports franchises. I think a better way to look at sports franchises is not compared to other businesses, but look at it compared to, let's say, a McDonald's franchise. If you're buying into a McDonald's franchise, you have a specific location and they kind of give you the tools, and then you can add some, additional things to increase revenue, but you're relatively limited to said location. That's similar to a lot of these sports franchises, right? Mm-hmm. You are limited to in the areas that you can go. You're primarily capped based on the market that you're in, but there's a lot of ancillary things you can do to increase interest, to increase, eyeballs, to increase foot traffic, to increase revenue at the end of the day. So I think that's kind of a relative, not a great analogy, but if you're just looking at kind of, how are sports franchises structured? You're structured underneath this kind of umbrella, but you're limited into, your market.
Well, and another question that you made me think of was, from a buyer perspective, I think just, and I don't pay attention as much as I should, but from my thought process over time, it seems like buyers in the past were more like individuals or groups or something like that. And now it seems like they're really kind of creating these conglomerate, like a group of people that then invest into the sports team. It's sort of like, they create a holding company or something and have all these investors that then go and buy the franchise. Do you see things have changed from the buyer pool or the buyer makeup? And what have you been seeing happen?
Yeah, what I would say is kind of by and large, these assets are well over $1 billion.
Mhm.
There's only a handful of people that can actually, afford that, right? Without breaking the bank. Um, so yeah, you often see kind of groups pooling their money together, and they'll designate an individual as kind of the general partner or the managing partner to kind of oversee everything. But it's a pool of a lot of people's money. One interesting thing that's happened in the sports space is that given the growth of these the values of these teams, a lot of sports leagues have allowed institutional capital, private equity capital, to invest. Only as a minority owner, you're a passive owner, you have limited um, benefits. But the main reason why this was happening was if you own 10% of a team, um, there's few people that want to spend $200 million to be a silent partner and not really get any benefits of a team. So they saw the secondary market for minority ownership stakes really slow down and become quite illiquid. And I think it's about 2 years ago, a majority of the sports teams are now allowing private equity to capture those stakes. In fact, there's been a lot of movement in that area over the past couple of months. There's a few firms that particularly geared a fund just to acquire limited partnerships and or limited minority ownership stakes in sports teams. So you're starting to see the buyer pool shift a bit, primarily due to just the size, how expensive these teams are.